How much a bank can lend me and what my monthly mortgage is going to be are one of the first questions I get asked by someone who's planning on buying a home. My name is Damaris and I'm with RE/MAX, and I've helped hundreds of families buy properties all over Westchester and Bronx County. Today, I'm going to go over everything you need to know to kind of figure out how much money you qualify for as far as the mortgage goes. So I know some people are super sensitive about their personal information, like how much money they make, how much money they owe. But when you're going through the mortgage process, the sooner you disclose this information, the better off you'll be. Now, I remember going through this process a few years ago when I was buying my first home with Jeffrey, and pulling the information out of him was impossible. I'm gonna walk you through a simple example of how banks qualify buyers to purchase their homes. Now, this is a general example, so I can't possibly convey everything to you. So if you have any more specific questions about your personal situation, you can always feel free to reach out to us. So typically there are 4 things that you need in order to qualify for a mortgage. You need some type of work history, right? So a job, and to be with that job for at least 2 years. The second one is a credit score. The third one is some type of down payment to put towards the purchase. And the last one is your debt to income ratio. And we're gonna go over in detail what your debt to income ratio is and how a bank qualifies that. A debt to income ratio is a percentage that the bank uses to calculate the maximum amount that you can pay back on your mortgage and your other debt. Your total debt payment is going to include your mortgage, your property taxes, your maintenance fee if you're buying a co-op and a condo, and any other minimum debt that you have that shows up on your credit report. To calculate your debt to income ratio, the bank is going to take your total gross income, so that's the money that you make before you pay taxes, and put that up against total debt that you have. So let's make this really simple. Say you make $120,000 a year, so you're bringing home $10,000 of gross income monthly. So you take the monthly income and you multiply that by whatever percentage the bank is using. For this example, we're gonna use 45%. So 45% of 10,000 is 4,500. And so essentially what the bank is doing is they're gonna qualify you on 4,500, meaning your monthly mortgage payment and any other debt that you have cannot exceed that 4,500. Now, the next thing the bank is gonna do is take that mortgage payment and chop it up, chop, chop, chop. So let's say you have a car payment, student loans, a couple of credit cards. The bank is gonna take all those minimum payments, add them together, and subtract from what you qualify for. So say that number is 1,000. Now you take 4,500 minus 1,000, and now your mortgage can't exceed 3,500. Chop, chop, chop. And then the next thing the bank is gonna do is gonna take that mortgage payment and deduct the property taxes. So for number's sake, let's say the property taxes are $6,000 a year, right? And that's $500, that comes out to $500 a month. You take 3,500, you reduce the 500 that you're paying in property taxes, and now you're left with 3,000 towards your mortgage. If you're buying a co-op, you're not reducing by property taxes, you're then reducing by your monthly maintenance. And if you're looking at condos, then you're gonna reduce them by both the HOA fees and the property taxes. The final step we take are the interest rates. So let's work backwards and plug everything into a mortgage calculator, right? At 7%, in order not to exceed the $3,000 monthly mortgage payment, we can borrow up to $450,000 on a home. Now, I gave you a very simple example, and the bank looks at many other things in order to qualify you, like your work history, your down payment amount, the credit score that you have, the different loan programs that they may offer. All these things matter. The bank is going to want to see all your documentation up front. This includes your tax returns for the last 2 years, your W-2s, bank statements, and your pay stubs in order to verify your current income. And if you're self-employed, your bank is gonna ask for all your business documents. So your business tax returns, your profit and loss, and possibly letters from your accountant. So if you have any more questions about buying a home and what you qualify for, feel free to message me. Thanks for watching.